a single ratio which explains you the company's cash condition at present. If I tell you in next 10 minutes the secret of company's actual cash position, how about that? Hi friends, this is Sagar, your investment, share market and astrology coach. Today I'm just going to share you a very important formula which is the crucial test for most of the companies, especially in a case when the most of the companies are funded. Now, as you see, the culture is of funding. So maybe it is a Flipkart, maybe it is a Zomato, maybe it is something else. Most of these companies are having funded money. So they do not earn profit and then make business, but they borrow the money and then expand their business. Now, how would you know about a single indicator which can explain you about how the company's cash position? Because friends, as we know very well that in a business, cash is the king. Liquid money is the most important money, because if you have some money in your hands, in your pocket, then you are the king because you have purchasing power. Now, what is happening with most of the companies that they are expanding like anything, but their cash position is very bad. For example, let's take example of maybe say Flipkart or any Zomato or maybe Nykaa fashions, which has collapsed from 1100 to say 100 rupees something. So you see, if I take all of these companies which are internet based, now you'll see that they are acquiring the customers, and that is how they are expanding their valuations. The only problem is that these companies do not have profit in their balance sheets, in their profit and loss statements. What they are doing is they are just infusing cash to acquire customers. Now what happens if the customer gets free benefits and then use that, and once the company starts charging, then the customer also leaves the company, moves to the competitor? Isn't that happening with most of the internet companies today? Because the customer is smart, he enjoys the free lunch and then moves away. Now, is there an indicator which can explain you that what is the condition of a company in terms of cash? Yes, the answer is yes. The ratio is known as current ratio. Now, what is current ratio? It's very simple. I think one of the simplest formulas. You take the balance sheet of a company and you pick current assets from it, then you divide the current assets by the current liabilities, and here you go, you have current ratio in front of you. Now, first of all, let's understand what is current asset and current liabilities. Now, friends, as we know that in a business, the business has some assets. That means there is money in hand, there is cash in hand, there is building, there are machineries, and so many assets are there. But see, the assets or maybe liabilities, they can be divided into two categories. The first is that those assets which can be utilized in 1 year are known as current assets, and those which are meant for longer period are known as long-term assets. For example, if a company gets or buys say a property or a building for its factory. Now building will not be consumed or utilized in just 1 year. It will be there for decades. But if a company has, say, cash, say 1 crore rupees for which is acquired this year as profit. Now this 1 crore rupees is current cash, right? So it is not deferred for so many years. So the point is, whatever is being considered as an asset just for 1 year is current asset, and the same goes for the liabilities. Now, what is how the current asset and current liabilities are different from long-term assets and long-term liabilities? Friends, it's very simple. Now today, if I have say 100 rupees in my pocket, is that important? Or if I get 100 rupees after say 6 months or maybe after 3 years, if I get 100 rupees after 3 years in my pocket, is that important? Or I have 100 rupees in my pocket right now, what is important? As obvious, the purchasing power today is more important. Therefore, the current assets matter a lot. Similarly, current liability is also important. Why? Because current liabilities are the liabilities which are falling within that year. That means anyhow you have to pay that. So, for example, say suppose you have a bank EMI or maybe an electricity bill, for example, or employee salaries, kind of things. They have to be paid in the same year. You cannot pay an employee after 1 year, isn't it? So if you have to pay something within the year, then it is current liabilities, which is very important to meet, right? So current assets and current liabilities gives you the clear picture of a company's current cash position, right? Now, friends, how as an investor or as a shared trader or maybe an interesting a person who is interested in share market as a student, how would we know that current asset is the current asset indicating something good or something bad about it, about the company? So it's very simple, friends. If we take the ratio, then this current assets divided by current liabilities, so the numerator is assets and denominator is liabilities. So the ratio, as high as the ratio can go, will be beneficial. The higher the current ratio, better it is. The lower the current ratio, the worse it is, right? It's very simple. Now, especially those companies which are into, say, FMCG or grocery or maybe any fast moving goods type of industry, current ratio matters a lot because the entire supply chain depends on the current assets and current liabilities condition. Now, say suppose there is Britannia Industries or maybe Hindustan Lever or Nestle or any other companies. Say suppose they have to make chocolates and biscuits. Now, will they buy the wheat and the sugar for these products uh, at present, or will they buy it after 5 years? Will they pay it for today, or they will pay it for after 5 years? No, because these are very fast moving goods. So what happens that the current cash position is very important. If they have cash in hand, they can go into the market and they can buy as much raw material as they want. They can produce it in terms of finished goods. They sell it and then they get the money back. This is how the cycle is moving. But the only thing is that this cycle is very quick, very fast. So in such companies, current assets are very important. Similarly, with the current liabilities, if a company is having so high current liabilities, that simply means that whatever cash it is earning out of business, that cash, the most of the part of it is being consumed by the current liabilities. That's a bad signal. I'll tell you how. Say there is a company, or maybe let's take example of a salaried employee, for example, right? Just to understand. So there is a salaried employee who has taken, who has purchased a car, a house, and say a television on the EMIs. Now, suppose his salary is say 50,000 rupees, and this EMIs of these three things is say 40,000 rupees in total. Now, what is happening? That person is left with only 10,000 rupees to spend on his grocery, on his entertainment, on his family welfare, everything. While on the other side, there is a person who is having salary as say suppose 30,000 rupees only, but that person doesn't have any kind of loan on him, so that 30,000 is there in his hand at the beginning of the month to spend on anything for on his family, on his entertainment, grocery, clothes, traveling, anything. So the 50,000 rupees employee is not enjoying that kind of life which a 30,000 per month employee is enjoying, isn't it? So similarly, if a company, maybe any big company, but if it has loan component or say fixed liabilities on it, especially the current liabilities on it, then whether this company wants to expand its business or not, but it has to depend, it has to depend on the cash outflow it is liable to meet. So first, whenever it gets the profit in its hands, then that profit is not directly spent on the shareholders or maybe on the business growth or expansion, but it has to first pay the EMIs or the current liabilities. So once that is done, then whatever left cash is left, that cash is being used for business expansion or for paying dividends to the shareholders or so many things. So the point is the current assets are a real power, and current liabilities are real problem for a company. Okay, because it is a liability. So when we divide these two, we get the current ratio. Then the current ratio, if the current ratio is more than say 1.5, that simply means that company is having 1.5 times cash or current assets in its hands as compared to the liabilities that it is going to meet. If say current ratio is 5 times of 5:1, or if I say current assets are divided by current liabilities is equals to 5, that's a very good position, because the company is having so much of current assets and it has no almost very little liabilities to meet. So in that case, the company's management is free to implement different type of marketing strategies, to launch new products, to install new factory, or can do so many things to expand their business. Right, friends? So please, whenever you study a stock, do not forget to understand the importance of current ratio. So friends, as today I'm just giving you an assignment, that today itself, after watching this video, please analyze at least 5 stocks on the basis of current ratio. But remember, they should be in the same industry, because current ratio depends on industry. So it varies from industry to industry. I will tell you more about that in coming days. So friends, I hope this video is useful to you. I will, after some time, connect the astrology with the financial wisdom and will give you a very clear-cut financial and investment path. But stay tuned till that time and take care of yourself. And yes, if you have not subscribed the channel, please do it now. I am giving you the research-based content. Right now it is just a theory part. Very soon we will be having assignments. We will be having so many case studies on Infosys, on Tata Motors, on Hindustan Unilever, and some troublesome cases just like Satyam Computers some time back, or there are some frauds or some irregularities are happening, or how to take care of the pricing movements using the candlestick charts or technical indicators. So we will cover everything like that. So to understand and to learn everything from me, just subscribe my channel and hit the bell icon right now. I know that most of the people have listened to it, but they don't do it. Friends, what is this? I mean, I'm doing a lot of hard work to bring the most complex knowledge in front of you in the easiest manner. I'm doing a lot of hard work. So I'm just asking not any money from you as of now. So what I request from you is just subscribe my channel, hit the bell icon, and share it with as many people as possible. That's it. That's a very small favor. So will you not do it for me? Thank you. I really appreciate your time, and from the bottom of my heart, I wish you all the very best for your financial journey. We will meet in the next video very soon. Till then, take care. Bye-bye.